All right, listeners, ready to delve in. Today we're tackling contrarian trading, and we've got a great source to guide us. Carl Futia's The Art of Contrarian
Oh,
Trading.
classic.
Yeah, so we're going to break down how to spot those market mistakes, the moments when things are just out of whack, maybe even figure out how to make a little profit from them.
Sounds like a plan.
So, you always hear buy low, sell high.
Yeah, the age-old advice.
But Futia, he takes a different approach.
Yeah.
He says it's less about like perfectly timing those peaks and valleys. It's more about recognizing when the market's, I don't know, kind of lost its mind a little.
When emotion takes over.
Yeah, exactly. When prices are being driven by like hype or fear, not by logic.
That's the key. You have to be able to think independently,
Right.
not just follow the herd.
Right. Got to go against the grain even when it feels a little scary.
It's not always easy. Even the pros can get caught up in the frenzy.
Oh, absolutely. Future
Sure.
even talks about Julian Robertson, the hedge fund manager. Super successful guy, but even he closed his firm in 2000, right at the peak of the dot-com bubble. He just couldn't, keep up with that market madness.
His value investing approach just couldn't make sense of it.
Yeah, it was like everyone had forgotten about, basic valuation principles.
It happens. That's where the idea of investment crowds comes in, I think.
Okay, yeah, fill me in. What are investment crowds?
So these are groups of investors, right? And they kind of glom onto a specific idea, a trend.
Like a hot new technology or something.
Exactly. But the problem is they're often driven by emotion, not, solid analysis.
So their collective buying power, it just pushes prices way up,
Sure.
even if the fundamentals don't support it.
You got it. It's like a self-fulfilling prophecy. And then, of course, you have the opposite effect when the bubble bursts.
Like the dot-com crash.
Yeah, perfect example.
Hmm.
Suddenly, everyone's panicking, selling off their stocks, pushing prices even lower.
It's like a vicious cycle. And I'm guessing the media plays a role in all this, right?
Absolutely. Futia talks about this information cascade effect.
Yeah.
People see others buying something and they assume, well, they must know something I don't.
So they jump on the bandwagon.
Exactly. And the media, they love to amplify these trends. It's all about those attention-grabbing headlines.
So how do we, as, savvy investors, how do we avoid getting caught up in these information cascades?
Well, one practical step is to, pay attention to what you're reading and hearing. Are you seeing the same stories repeated over and over, the same predictions, just getting bolder and bolder?
That could be a red flag.
Right. Might be time to take a step back. Ask yourself, is this hype or is this real?
Okay, so we got to be skeptical. But how do we actually figure out if an asset is truly overvalued? Is there like a tool we can use?
Futia suggests looking at the 48-month moving average of the S&P 500.
Okay, and what does that tell us?
It gives you a sense of the market's long-term trend. You can compare a specific stock's price to that average and see if it's way out of line.
So if it's way above the average, that could be a sign of irrational exuberance.
Could be. Worth investigating further, at least.
Makes sense. It's like it gives you a benchmark, something to measure against.
Right. It's not foolproof, but it's a good starting point. And what's interesting is that historically, periods of overvaluation tend to last longer than periods of undervaluation.
Oh, so it's easier to get caught up in the hype to ride that wave for longer?
It seems that way, like with the peak oil bubble in the early 2000s. Remember that?
Yeah. Yeah, when oil prices went through the roof.
People were convinced oil production was about to peak. Drove prices way up based on fear.
But it turned out to be a false alarm.
Right. So we see this pattern of fear or exuberance driving overvaluation and then eventually a correction. Futia even points out that big market tops are often preceded by unusually short bear markets.
Like a calm before the storm.
Could be something to watch out for. And again, the media plays a role. They don't just report the facts, they tell stories. And those stories can have a huge impact on investor behavior.
Yeah, it's all about the narrative. And sometimes it feels like the narrative takes on a life of its own, regardless of whether it's actually true or not.
Absolutely. The media is incentivized to create those compelling narratives, even if they're a bit distorted.
So that's where Futia's idea of a media diary comes in, right?
Exactly. He suggests keeping track of the stories and themes you're seeing in the news.
So like literally writing them down or bookmarking articles.
Yeah. It helps you become more aware of those information cascades as they're happening. You can see how certain narratives gain traction and start to influence the market.
So you can compare those narratives to what's actually happening with the numbers.
Right. Because remember, as contrarian traders, we're looking for those moments when the story and reality have diverged.
When the crowd's so focused on the hype that they've missed the warning signs.
Exactly.
Okay, I'm starting to get the picture here. We need to be skeptical of the media, we need to understand history, and we need to think for ourselves.
That's a great summary.
But where do we go from here? How do we actually put these contrarian ideas into practice?
That's the million-dollar question, right? How to actually, make those contrarian moves. And there's no easy answer. It's a process.
Yeah, no magic formula, unfortunately.
Nope. But it starts with, having the right mindset.
Okay, so what does that look like? What's the contrarian mindset?
It's about being curious, digging deeper, questioning assumptions, not just taking things at face value.
So, like, don't just believe everything you read in the headlines.
Right. Do your own research, look to the cracks in the story, and, be willing to go against the grain.
Even when it feels a little risky.
Exactly. It takes courage to be a contrarian.
Okay, so let's talk about some actual strategies. You mentioned short selling earlier. Can you unpack that a little?
Sure. So short selling is basically you're betting that the price of an asset is going to go down.
So you're trying to profit from the decline.
Right. You borrow shares of a stock, you sell them at the current price, and then you hope to buy them back later at a lower price.
Okay, so if the price drops, you make money, but what if it goes up?
Well, that's the risk. Your losses could be theoretically unlimited.
Yikes. So it's not for the faint of heart.
Definitely not. It's a high-risk, high-reward strategy, requires a lot of knowledge and discipline.
So maybe not a beginner's move. What about some other contrarian approaches? Something a little less, terrifying.
Sure. Value investing is a classic contrarian strategy.
Okay, I've heard of that. Remind me how it works.
It's about finding companies that are essentially on sale. They're undervalued by the market.
So like hidden gems that everyone else is overlooking.
Yeah. Maybe they're out of favor or facing some temporary problems, but their fundamentals are solid.
And the contrarian part is you're buying when everyone else is selling.
Exactly. You're betting that the market will eventually recognize the company's true value.
And hopefully the price will go up.
That's the goal. But of course, it takes research. You got to make sure the company is actually undervalued, not just cheap for a reason.
Right, got to do your due diligence. So we've got short selling, value investing. Any other contrarian tricks up your sleeve?
Well, Futia talks about event-driven investing. This is where you're looking for opportunities created by specific events.
Like what kind of events?
Mergers, acquisitions, spin-offs, that kind of thing.
So you're trying to anticipate how these events will affect a company's stock price.
Exactly. Sometimes the market doesn't react rationally to these events. It might overreact or underreact, creating opportunities for contrarian traders.
Okay, that makes sense. So it's like you're looking for those moments of disruption where you can capitalize on the market's inefficiencies.
You got it.
But I'm guessing this requires a pretty deep understanding of, like, corporate finance and stuff.
It does. And the ability to act quickly when those opportunities arise.
Okay, so definitely not for the passive investor. But regardless of the specific strategy, it sounds like having a solid decision-making process is key.
Absolutely. You need a system, a way to evaluate information, weigh the evidence, and ultimately make those tough calls.
So it's not just about gut feeling.
No, not at all. It's about combining your intuition with, solid research and analysis, using all the tools we've talked about. Media diary, historical analysis, market semiotics.
Okay, yeah, let's circle back to market semiotics. I'm still a little fuzzy on how to actually read the market, like it's a book.
It's all about patterns, really. Looking at price charts, understanding how volume and price interact, those kinds of things.
Can you give me an example? Like, what would a bearish signal look like on a chart?
Well, one classic pattern is the head and shoulders formation.
Okay, I've heard of that, but I've never really understood it.
So imagine a price of a stock is going up, right?
Yeah.
It reaches a peak, then drops back a little, then it goes up to a higher peak, drops back again, and then makes a third peak that's lower than the second one.
So it's like it's trying to rally, but it just can't quite get there.
Exactly.
Yeah.
That's often a sign that the upward momentum is fading.
Interesting. What about volume? How does that factor in?
Well, sometimes you'll see a divergence between price and volume. The price might be going up, but the volume of trading is going down.
So, like, fewer people are actually buying the stock, even though the price is rising.
Right. That can be a sign that the rally is running out of steam.
Like a party where everyone's pretending to have fun, but they're all sneaking out the back door?
Perfect analogy.
Mm-hmm.
And remember, these are just a couple of examples. There are tons of different chart patterns and indicators the traders use.
So it takes some practice to learn how to interpret them.
It does. But there are lots of resources out there to help you. Books, websites, even software that can do some of the analysis for you.
Okay, so we're learning to read the market's language, but even with all these tools, contrarian trading is still risky, right?
Of course. There are no guarantees in the market, but by understanding the psychology, the history, the patterns,
We can at least tilt the odds in our favor.
exactly. And just as importantly, we could avoid those big emotional mistakes that can really hurt us.
Right. It's about staying calm, thinking clearly, not getting swept up in the hype or the panic.
Precisely. And that brings us back to that contrarian mindset. It's about having the confidence to think differently, to challenge the status quo, to trust your own judgment,
Even when everyone else is telling you you're wrong.
especially when everyone else is telling you you're wrong. That's when you know you might be onto something.
Okay, so as we wrap up this section on contrarian strategies, what's the key takeaway for our listeners? What should they be thinking about as they, digest all this information?
I think the most important thing is to remember that markets are driven by human beings. And human beings are, well, let's just say we're not always rational.
We're emotional creatures.
Exactly.
Hmm.
We get caught up in stories, in trends, in the fear of missing out. And that's what creates those market mistakes that contrarians can exploit.
So it's not enough to just crunch the numbers. We need to understand the psychology behind those numbers.
Right. We need to be able to see the market through a different lens,
Yeah.
to recognize those moments when the crowd is getting it wrong.
When the narrative and reality have diverged.
Exactly. And that's where the real opportunities lie.
All right, I like it. So we're becoming contrarian detectives, searching for those clues that everyone else is missing.
That's a great way to put it. And the more you practice, the better you'll get at spotting those clues.
So keep learning, keep questioning, keep exploring, and maybe, just maybe, you'll find yourself on the right side of the next market mistake.
Now you're talking like a true contrarian.
Hey, I'm learning from the best. So we've covered a ton on contrarian trading, but is there anything else in Futia's book that really stood out to you? Anything we haven't touched on yet that our listeners should know?
Yeah, one thing that really struck me was his emphasis on market history, like really understanding how markets have behaved in the past. He says it can give you a huge advantage.
Yeah, that makes sense. Learn from the mistakes of others and all that. But where do you even begin? There's so much financial history out there. It's kind of daunting.
Well, he suggests starting with those big market crashes and bubbles, like the 1929 crash, the dot-com bubble, 2008.
Oh, yeah, those are the classics.
Right. And as you study them, you start to see patterns emerge in investor behavior, in valuations, even in the narratives that drive those big swings.
So it's not just about memorizing dates and numbers. It's about understanding the psychology behind those events.
Exactly. Like, what were people thinking at the time? What were the factors that led to the bubble or the crash?
Yeah.
How did investors react?
And what can we learn from those mistakes, right? So we don't repeat them.
Exactly. So you're looking at the present through the lens of the past,
Yeah.
trying to recognize those echoes of history that might be playing out today.
Okay, that's a cool way to think about it. But how do you avoid getting lost in all that data? It can be a lot to process.
Well, you have to remember why you're doing it. You're studying history to make better decisions in the present, right?
Right.
So as you're reading about those past cycles, keep the current market in mind. Ask yourself, are there any parallels, any warning signs that maybe others are missing?
So you're using history as a guide, not like a set of hard and fast rules.
Exactly. History doesn't always repeat itself exactly, but there are these timeless principles of, human behavior and market dynamics that tend to show up again and again.
And by understanding those principles, you can be more aware of what's happening in the market, more prepared for those shifts in sentiment.
Right. You're not just reacting to the headlines. You're thinking ahead, anticipating what might come next.
Okay, so it's not just about being contrarian to be different. It's about having a well-informed perspective, one that's grounded in history,
Precisely. And that brings us back to Futia's main point, I think. Thinking independently, not just blindly following the crowd.
Yeah, being able to see beyond the noise and the hype, to question what everyone else is taking for granted. It's like you're the captain of your own ship, navigating those choppy financial waters.
Great analogy.
Hmm.
But even the best captains, they hit rough seas sometimes.
Oh, yeah, you're going to make mistakes. Everyone does.
The key is to learn from them.
Right.
Refine your process. Keep honing your skills.
So it's a journey, a constant learning process.
Exactly. You have to adapt and evolve as the market changes.
And, maybe even enjoy the ride a little bit. I mean, contrarian trading, it can be pretty exciting, right? It's like a puzzle to solve.
Absolutely. It's intellectually stimulating, for sure. You're engaging with the market on your own terms, not just following the herd.
And, maybe even those Those curveballs the market throws at you, maybe those are the moments that really make you a better investor.
That's a great way to look at it. Embrace the challenges, learn from your mistakes, keep questioning and exploring.
Well said. So, listeners, that's our deep dive into contrarian trading. Hopefully, you've learned some valuable insights today. We covered a lot from market psychology to chart patterns to those all important contrarian instincts.
We talked about how to identify those moments when the market's maybe gotten a little ahead of itself.
When how to use history as a guide to avoid repeating those classic mistakes.
And most importantly, I think we emphasize the need to think for yourself, to question everything, to be courageous in your convictions.
So go forth and conquer those markets, everyone. But do it wisely, stay informed, and as always, happy trading.